Fast growing revenues, profit doubling, margin improving, and yet one decision by the promoter has raised serious questions. Today we are decoding a company operating at the intersection of healthcare, outsourcing, and artificial intelligence. Let's find out the future compounder. Stability Limited is one of the companies that quietly operates behind the scenes yet plays a crucial role in one of the world's largest industry, healthcare. At first glance, it may appear to be just another IT or outsourcing company, but its real strength lies in its deep integration with the US healthcare ecosystem. The company works with insurance providers, hospitals, and healthcare institutions, managing complex processes like claims, payment, patient engagement, and analytics. In many ways, Sagility acts as a silent backbone, ensuring that the large parts of the healthcare ecosystem function smoothly. But what makes the story truly compelling is not just its current operations, but its transformation, a gradual shift from a traditional outsourcing model to a modern, advanced, AI-driven healthcare solutions company. This transformation is clearly visible in its financial performance. Over the last few years, the company has delivered consistent revenue growth, scaling from around 4,200 crore to over 5,500 crore, reflecting a steady annual increase of nearly 15 to 17%. However, the real turning point lies in its profitability. Profits have surged dramatically from approximately rupees 143 crores to over 500 crores, signaling that Sagility is not just growing in size but also improving in efficiency. This sharp rise indicates a strong operating leverage where costs are controlled while revenue expand, allowing margin to improve. Operating margins are now in the mid 20% range, and quarterly results further reinforce this momentum, with revenue steadily rising, margins touching around 26%, and profits in some quarters growing more than 100% year on year. What was the once volatile profit trend is now becoming more stable, hinting at a maturing business model. The company has significantly reduced its debt from over rupees 2,500 crore to nearly 1,400 crores, which strengthens financial stability and reduces risk. At the same time, a notable portion of its assets consists of goodwill and intangibles, primarily due to acquisitions. While these acquisitions support growth and expansion, they also introduce a layer of risk, as future performance must justify these valuations. But just when the story seems to be standing fundamentally, a major development shifts the narrative. In May 2025, promoter of the company sold 703 crore equity share through an offer for sale. This transaction represented 15.02% of the total share capital, reducing promoter holding from 82.39% to 67.38%. More importantly, these shares were previously under indirect encumbrances linked to financing facility provided by various international lenders and security agents, indicating that the sale was not merely profit booking but part of a broader financial restructuring. If we look deeper into the shareholding pattern, the transition becomes even more striking. As of March 2025, the promoter and promoter group held 82.39%, which reduced to 67.38% by June 2025 after the offer for sale, and further declined to around 50.95% by December 2025. At the same time, institutional investors significantly increased their presence. Foreign institutional investors (FIIs) increased their stake from approximately 3.39% in March 2025 to around 10.25% by December 2025. Similarly, domestic institutional investors (DIIs) saw a sharp rise from about 7.47% to nearly 21.36% during the same period. Within DIIs, mutual fund alone held about 13.36% stake. The retail side, public shareholding increased from roughly 6.7% to around 17.44%, reflecting a growing participation from individual investors. Clearly shows that Sagility is moving from a promoter-dominated company to a more institutionally held structure. On one hand, rising institutional ownership signals confidence from large investors and improved market credibility. On the other hand, a sharp decline in promoter holding raises questions about long-term commitment and control. This dual narrative is exactly why the stock currently carries mixed sentiment in the market. Looking ahead, Sagility's growth driver remains strong. The US healthcare market continues to expand, offering a massive opportunity for outsourcing and digital transformation. The company's increasing focus on artificial intelligence and automation, especially in claims processing, fraud detection, and analytics, position it well for further margin expansion. However, risk cannot be ignored. The company remains heavily dependent on the US market. Its return on equity is still relatively low at around 7%, and the promoter stake reductions continues to influence investor perception. In the end, Sagility stands at a critical turning point. It is a company evolving from outsourcing to intelligence, from scale to efficiency, and from steady growth to potentially exponential profitability. But alongside this transformation, the question of trust remains central. If execution continues and institutional confidence strengthens, Sagility could emerge as a long-term compounder, but if concerns around promoter actions persist, the journey may remain volatile. Because in the stock market, growth may attract attention, but trust sustain. Sagility Limited currently trades in the range of around rupees 42 to 48 per share, with the market capital between 20,000 crores to 22,600 crores, placing it in the small cap to emerging mid cap category. The face value of the company is rupees 10 per share, and its valuation reflects a PE ratio in the range of 26 to 37, indicating moderate pricing with growth expectations already factored in. While not cheap, it is not also excessively expensive compared to a high growth technology and analytics companies. When compared with the peers, Sagility's position becomes clear. It is not directly competing with the large IT giants like Tata Consultancy Services or Infosys, which operate at a completely different scale, with the market capitalizations in the range of 5 to 9 lakh crores. Instead, Sagility is better compared with the mid-size BPM analytics companies such as Firstsource Solutions, eClerx Services, and Indegene. Among these, Firstsource has a market cap of around 17,000 to 18,000 crore, making it a close comparable in the terms of scale, while eClerx and Indegene fall in a similar mid-tier bracket. Within this peer group, Sagility stand out for its strong healthcare focus and improving margins, which are around 24 to 26%, comparable to or slightly better than some competitors. However, it still lacks in the return on equity at near 7%, which is lower than several peers that generate better capital efficiency. Additionally, some analytics focused companies trade at higher valuation due to the strong digital positioning, while Sagility is still in a transition phase toward AI-led services. Overall, Sagility occupies a middle ground, larger than smaller BPM players, but not yet the scale or efficiency of top-tier companies, making it a growth-oriented but still evolving player in its segment. This was the analysis of the Sagility Limited. Thank you for watching. See you in the next video. Bye bye.